Welcome to The Explainer. So today we're diving into a topic that, okay, I admit, might sound a little technical at first glance. But trust me, it's actually a phenomenal tool for building real wealth through real estate. We're talking about the newly announced 2026 conforming loan limits. Let's break down exactly why understanding these numbers could be an absolute game changer for you.
Could these new 2026 loan limits actually save you thousands of dollars on your mortgage? The short answer? Absolutely yes. Picking the right loan, or, knowing exactly when to refinance an existing one, can literally save you thousands in hidden fees and interest over the life of your mortgage. It's a huge deal.
All right, here's our roadmap for today. Number 1, the 2026 loan limits are here. 2, how those limits are determined. 3, conforming versus jumbo loans. 4, the Fannie and Freddie factor. And finally, number 5, what this all actually means for you. Let's dive in.
Part 1. The 2026 loan limits are officially here. Let's take a look at these new baseline numbers. The Federal Housing Finance Agency has officially dropped the new baseline limit. And wow, it is a big one. $832,750. That exact number dictates the absolute maximum amount you can borrow for a standard one-unit home in most markets nationwide. But what's really fascinating here is how drastically these limits shift based purely on your zip code. Take Southern California, for example. Baseline markets like Riverside and San Bernardino sit right at that standard $832,750 mark. But if you just cross the county line into high-cost markets like Orange County or LA, that ceiling absolutely skyrockets to over $1.2 million. So yeah, your location completely dictates your lending ceiling. Moving right along to Part 2. How are these limits determined? Let's take a quick look behind the math.
Well, it basically all comes down to the Home Price Index formula. Now, I know that sounds like a question on a really tough math exam, but honestly, it's just a bureaucratic way for the FHFA to track housing affordability across the country. Essentially, as homes get more expensive, the government bumps up these limits so everyday people can actually still borrow enough money to buy them. Just look at this historical jump. Back in 2017, the baseline limit was just $424,000. Fast forward to 2026, and it's practically doubled to $832,750. It's a pretty stark visual of just how challenging home affordability has become over the last decade, right?
Okay, Part 3. Conforming versus jumbo loans. Which one is the right fit for you? First up, we have the conforming loan. This is simply a mortgage that plays nicely by the FFHA's rules, making it eligible for purchase by Fannie Mae and Freddie Mac. Basically, if your total loan amount stays under your county's specific limit, you fit neatly right into this highly desirable conforming category. But what if you need to borrow, say, literally just $1 more than your local limit? Well, that immediately pushes you into what we call jumbo loan territory. And because that loan exceeds the conforming limit, it's deemed a lot riskier for lenders. That completely changes the rules of the game.
Let's contrast these two directly, because this is where it really hits your wallet. Conforming loans generally offer you significantly better interest rates and lower mortgage insurance. Jumbo loans, on the other hand, they usually require much stricter underwriting, way higher fees, and higher rates across the board. Why? Because lenders just view those higher balances as a much bigger risk. That brings us to Part 4, the Fannie and Freddie factor. Let's look behind the scenes of the mortgage market. To really understand why conforming loans are undeniably cheaper, we have to look at the life cycle of a loan. See, you borrow money from a bank, right? But your lender rarely actually holds on to that debt. Instead, they bundle your loan with a bunch of others to create financial assets. Then these massive investors, specifically Fannie Mae and Freddie Mac, come in and purchase those bundles. So ultimately, you're actually paying your interest to them. And here's the punchline of all of this. High investor demand leads to much better pricing for you. Because Fannie and Freddie so eagerly buy up these less risky conforming loans, your lender can pass those exact cost savings directly down to you in the form of lower interest rates. Jumbo loans simply just don't have that same kind of massive investor appetite. Which leads perfectly into our final section, Part 5, what this actually means for you and how you can take action. All right, here is where it gets incredibly real. Let's say you bought a home last year and you were forced into a jumbo loan just because you were maybe slightly over the 2025 limit. Well, with these newly increased numbers, you might actually fit right under the 2026 conforming limit today.
By refinancing, you could dramatically lower your interest rate, completely drop your mortgage insurance, and literally shave hundreds of dollars off your monthly payment.
So you can really put this knowledge to work right now. Go online, look up your specific county limits, and use those exact numbers to estimate your true affordability. You'll want to compare side-by-side loan options, or, better yet, contact a mortgage broker. They can help run the math to see if making a move makes sense for you and your family right now.
I want to leave you with this final thought. Are you absolutely sure you have the right loan? Knowing your local limits can genuinely save you thousands. So calculate your break-even point and make absolutely certain you aren't leaving your hard-earned money on the table. Thank you so much for joining me on this explainer, and hey, here's to building some real wealth.